The TSP I fund. I as in India for international stocks. Let's dive right into it here today at the Heritage Wealth Planning YouTube channel. Thanks for coming on board. If you like what we see here, don't forget to hit the subscribe button right down there. That little red button that says subscribe, hit that, and click on the notification bell down there as well, because we do one video a day here at Heritage Wealth Planning, and you want to keep up with it because we talk a lot of stuff that can affect you. Social Security planning, estate planning, tax planning, obviously TSP and investment planning, everything under the sun financial related, we're going to talk about it here. So subscribe and hit the notification bell. All right, so let's dive right into it. This is the last of our TSP funds. So remember, the TSP just has 5 investment choices. Now, you have the G fund, the F fund, the C fund, the S fund, and the I. All right, so those are 5 funds, and now you have the life cycle funds in there as well. We'll talk about that in one episode. I might even do that here today as well. But the I fund is the last of the 5 individual choices that you have. So let's dive right into it. And the I fund's the international. It follows the Morningstar, the EFA, which is the East European Asia Far East. Is that right? I think it is. European Asia Far East, the Morgan Stanley Capital Indexed EFA. Yeah, Europe, Australia, Asia, Far East. That's what it is. Europe, Australasia, okay, Far East. So basically the developed world markets. That's what this is. Large companies, mostly developed world markets. And the I fund, just like the other 2, the S fund and the C, use an indexing approach. In other words, it's a passively managed fund that remains invested at all times. All right, so you're not going to go to cash. You're not going to have any exposure to safe assets when the market's getting tanked, and they're not going to have cash as a headwind when the market's going up either. Okay, now anytime you're investing into stocks, there's risk. There's even more inherent risk investing in foreign countries for sure. From the dollar value, the trading currencies, all this, everything on the sun is more risky when it comes to international markets. Never mind just international regulation, politics, the whole thing. But the facts are the international markets do give you a nice way to diversify a 100% U.S. stock portfolio. You can lose money. I mean, it's just a fact, and you could be in there for a long time and not make much money too. So let's take a look at the performance of this guy. All these funds, this fund performance, fund options. I just want to see if they talk about, let's just go to overview. I wonder if this fund has the same, expense ratio. That's what I wanted to see there. All right. It doesn't say explicitly on this fund, but the average net expenses is 3.3 bips, which means it costs 33 cents per $1,000 per year, which is incredibly cheap. I don't know that the I fund is that cheap, but it doesn't say. But presumably it's no more than 4 basis points, which is, I'm telling you, it's incredible cheap how cheap that is. So let's go to returns here. This is what we have for the I fund. Let's start with the individual charts, and we'll go down to the bottom here. Yeah, so very choppy. Been around since 2001, which is not the best time to start. Here's the S fund. Here's the I fund. A lot of similarities. See that? Down, 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 down. Up, 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 down, down 2011, down 2011. The S fund in 2011 was up just a tad, or that's the C fund, excuse me. Then we had a couple years. Look at that right here, 2014, 15, and 16. It was down net and didn't do much. In fact, I remember in 2015, we had a pretty significant sell-off on both the small caps and the international stocks. I want to say it was like May to June of 2015. They're both down pretty significantly. They're both in bear market territory. And so what you have here is everyone and their mom's like, oh, these funds stink. And that's not the right answer. That's when you want to buy it for sure. Then 2017, it came roaring back. But everything kind of mimics the S fund here, except for this year here. We started growing a little bit out of the hole that we put ourselves in 2014-15, and the S fund had already taken off in 2016. Now we're taking, the international funds are doing quite well now, 2017. But anyway, so that's the choppiness. I mean, you got some serious, we'll see, 6 down years of a 16-year track record. So we got 6 divided by 16. That means it's down 37.5%. So basically, a little bit more than a third of every year 1/3 of all the years that it's been around has lost money for sure. And we've lost pretty significant money too. All right, so let's take a look at the table here of what it's done over the last 10. It's only averaged 2.23. So everyone, all right, so this is where it gets funny. All right, so a lot of people would say, oh, that's done worse than the G fund. In fact, I saw a guy who I actually respect, but he was talking about the G fund versus the I fund and how the I fund was the worst of the TSP because it gave you less return than the G fund with a whole lot more volatility. It's true, but don't let that dissuade you because what happens in the stock market, everything's going to be up and everything's going to be down at some point. It doesn't matter, large caps, small caps, international, gold, it doesn't matter. At some point, you'll say, man, why did I invest in that? It should have stuck with a G fund. I've heard that a million times a Sunday. I should have done this. I should have done that. That would have given me, a CD would have outperformed this without the risk. Well, that's true. Now, let's look back 10 years from now. Let's see if that same thing happens. Who knows? But if I was a betting man, and I'm not, I'm just a diversified investor, as you should be, I said, okay, over 10 years, the C fund has had no down years. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9. So we've had one down year in 10. The S fund has had a couple down years. The I fund has had 1, 2, 3, 4 down years in 10. That's average 8.5. That's average 9.37. That's only average 2.23, which is literally the worst of all 5 funds. What has more upside? What do you think? What has more upside? We know for a fact that G has no upside other than the yield it currently is paying, which is probably about 2.5 to 3. The F fund is paying a little bit more than that, and that's all you're going to get. Because remember, bonds don't give you growth; bonds give you interest. You're only going to get the interest that you're making right there. You're not making more than that. Now, the C fund could tear it up, but the price is high or low relative to historical earnings. They're somewhat high. They're not nosebleed high, but they're certainly not low. The S fund, the price is high versus low versus relative to earnings. So they're pretty high. There's no getting around that. The international stuff, are they high versus low? Well, they're on the lower side. And so anytime you have low price, low return, that generally means it has more outstanding potential, upside potential going forward. Who knows? But if I would absolutely steer you away from this fund. There's no reason to steer away from this at this point. Yeah, you have any money. But, we had a nice year last year, but you had to look at that. I mean, these 3 years right here, you made nothing. You lost money. It already had its bear market, as did the S fund. Already had its bear market in the last 4 years. Like I said in previous episodes, every 4 years or so, the markets fall 25%. And it's happened for both these guys in just the near past. Hasn't happened to C fund. Now, I'm not here to predict this. I have no clue, and you have no clue. But just my numbers say at the end of the day, we've already had our bear market. We've underperformed for 10. Already had our bear market. We've done pretty well for 10. Haven't had our bear market. We've done pretty well for 10. So if I'm diversifying, as you should be, I'm certainly not getting rid of this because the performance hasn't done great. I just don't do that. That's silly. That'd be bad investing for sure. Now, should you put 100% of your assets in there? No, of course not. But we'll get into some asset allocation models here in just a second. But I'm a fan of the iFund, actually. And let's just go back to the Vanguard. The iShares, because I don't think Vanguard, I don't think they have I'm not sure. They have VWO, which is their emerging market index. I don't know. But here's their, that's a Vanguard ETF for emerging markets. But here's the EFA ETF iShares. It's been around for a while. Let's just look at the performance so I can show you what is done historically. All right. So basically, we go back to 2003 and look at it. I guess that's the same time as ours has been. Let's just see what the track record has been since, because this TSP only gives us going back to 10 years. It doesn't give us, okay, good. So this track record is going to follow the EFA to a T. So let's see what the EFA has done going back to 2000 when it initially started. Let's see if we can see that return here. Inception date 2001, almost the same exact time as the iFund on the TSP. Let's see. It doesn't give us a performance since inception. All right, so let's go to maybe it'll be in profile, I think. All right, let's check out profile since inception. Folks, so having an issue with the Yahoo Finance, but we're back here. So let's take a look. So we got the EFA, which is the blue. All right. Then we got the emerging markets. I mean, the S&P 500. And then we got the emerging markets in pink. EFA is in blue. That's the developed markets. Emerging markets in pink. And the S&P 500 is in light blue. So anything jump out at you here? Look at the emerging markets. Tore it up from 2001 until 2007. And we're talking huge rates of return. Huge rates of return. Kind of reminds you of gold fund, does not. And then it just got crunched and then up and then, but so look, here's emerging markets from there to there. It's not up, my friends. That's down. All right. Now from here to there looks pretty good, does it not? But from here to there is still down. That's not good. You don't want to be down over 12 years time. Now here's the international, the EFA, again, the developed markets. And again, it was just dominating the S&P 500 to begin the decade. It just was. And then kaboom, and it's since not done it. Literally same thing. It's done nothing. It's done nothing. Boink, right there. So if you would have invested in this in 2001, you've made all of 68% total from 2001 until today. And again, here's emerging markets. If you would have invested in 2001, you've made 168%. Which is, pretty good, relatively to speaking, what that drop was right there, which is significant. Here's the blue, the light blue, the S&P 500. So let me ask you a question. Who was right here, 2007? Look at what the emerging markets did or had done. Look at what international markets had done. How many people do you think were sitting there saying today that the worst fund in the S and the TSP was a C fund? I think there was a lot. They should be more than international. Absolutely, because it was underperforming. And look at that. It's getting hammered by both these guys. Now, the S&P has come around nicely. Look at that light blue. The trajectory from here to there has been just solid as can be. A little bit of sell-off in 2011, a little bit to start 2016. But look at that. I mean, it's just shoops, a nice like a elevator or an escalator going to the northeast, which is what you want. Look at the choppiness of the emerging markets. And our friend at a different place was saying that he wishes the TSP had an emerging markets almost in lieu of the international. And I don't agree with that at all. And then you look at the EFA, which is just choppy and kind of flat. Interesting, huh? So what would say to you if you're an investor who has done better since then, right here, 2009 till today? And one of the facts are the S&P 500 has done better. Who has done worse? Well, the facts are the EFA has done worse. Where would you put your money? In what has done better over the last 10 years or what has done worse? Or maybe mix it up, which is what you should do. Well, it certainly isn't to just neglect the thing that's underperformed, because that would be silly. Then you would have neglected this right here, and you would have invested in these right there. And you don't want to do that. You don't want to be neglecting stuff just because the performance hasn't done as well as other things. That's the epitome of bad investing. So let's go over here to 2000. Let's go to 2000. I'm just curious. We'll go to 2009. I'm not trying to convince you to invest in an iFund. I'm just saying at the end of the day, you need a diversified portfolio, and the iFund fits the bill. All right, so here's the end of 2009, and here's the S&P 500 is almost, look at that, up 253%. Here's the emerging markets is up, basically doubled since then, and here's the international, which is only up 87%. All right, so look at that wide gap right there. That I'm just telling you, that tells me that there's a lot more opportunity in these things down here than there is up there, for sure. All right, so let's just look at one other thing while I'm yapping here, because it's pretty interesting to me. I do want to look at, let's go to the profile and see if it gives us a PE ratio on the stocks within the developed. Yeah, I don't think so. Just wonder what the average PE price, the price earnings ratio that I'm talking about. Let's see if we have summary. I didn't think so. But how would, I don't know. All right, so what a PE ratio is, the price that you're paying for a dollar of earnings. The higher the PE, the more you're paying for a dollar of earnings. And right now, the dollar of earnings on the S&P 500 is about 16 to 17, with a price per PE ratio right there. And it doesn't have trailing 12 months, so we're not seeing anything. The PE ratio on the EFA, last I saw, was about 11. So that means you're paying $11 for every dollar of earnings on the international markets, versus $16 to $17 you're paying for every dollar of earnings on the markets that we have in the United States. I'm just curious. So while we're looking at that, let's go to USMIX. That'll be I don't know if this will have a PE ratio because it's the extended market index. Let's find out. So based on looking at the extended market index, I'm curious to see what the small cap PE ratios are. Let's see here. I don't see any PE. That was under profile. Yeah, I don't know why it doesn't have a PE ratio there. Look at the profile. So the PE ratio is the price. Shoot. I don't know why I didn't have maybe because of mutual fund. I don't know. Anyway, so at the end of the day, small caps have a higher price earnings ratio. Large caps have a lower than the small caps, but both of those are certainly much higher than international markets, which tells me that in terms of cheapness, the international markets are cheaper. Now, there might be a reason for that. When you find something that's cheap, typically it means there's a reason for that. But not all the time, not for long-term investors. So I know this is kind of long video here, but don't neglect, get rid of your iFund, not for a truly diversified portfolio. You need it. You need to have some international markets. The fact it hasn't done anything for 10 years should encourage you even more to have international markets just to keep up with a nice, well-diversified portfolio. All right. As always, I hope you like what you see here. Thumbs up are always helpful. Don't forget to subscribe. If you do subscribe, hit the bell for being notified of future content. Comments always welcome. And don't forget to go to the blog at heritagewealthplanning.com. See you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.